Stocks are mixed today. The S&P 500 holding above the 6,000 level. The benchmark index has bounced over 20% from its April lows. Our next guest calling for caution amid the rally, citing recent weakness in economic data. Joining us now, David Kelly. He is JPMorgan Asset Management's chief global strategist and head of the Global Market Insights strategy team. David, it's wonderful to speak with you. Thank you for making the time this morning. I know in your latest, you talk about how you see an economy that is slowing and causing trouble in the foundations of the market and the macro environment. What is that slowing looking like to you?
Well, yeah, we're seeing a fairly broad slowdown in economic activity, and there's a lot of noise in the data. So this is hard to, it's hard to see sometimes. And I think also when you look at the market having done very well over the last 2 months, you might think that there isn't a slowdown going on, but there is. You can see that in the labor market data, that 95,000 downward revision to payroll employment growth for the last 2 months means that average payroll growth has just been 124,000 per month in the first 5 months of this year. That's slowing. We can see also other data like a falling labor force participation rate, a lot of layoff announcements. All that suggests that the labor market's slowing. And then when it gets to the real economy, I mean, we're looking at things like declining tourist activity. We can see that in data on TSA checkpoints, or non-immigrant visas. We can see the signs in the auto industry of people buying cars before the tariffs. That's going to slow down. So you can see this overall slowdown going on. Meanwhile, I don't expect the Fed to cut rates anytime soon. And that combination really means people ought to be a little bit cautious here because the markets, the correction is over. The market's up year to date, but there really are more problems than we had at the start of the year.
So what do you make of the fact that the party is continuing? To your point, you've got the equity party upstairs while the basement is leaky. What is that a sign of? If it's not economic strength, is it big tech's resilience?
Well, I think it's a little bit of its investor confusion, and some of it may simply be plenty of money in the hands of rich investors. I mean, we've had a lot of money sitting on the sidelines for years. That money gets pumped into markets. We've got a very unequal income distribution. So, there's often a disconnect between the economy and markets. But it's also a little bit of a waiting game here. We haven't seen the real effects of these tariffs and pushing up in inflation, slowing growth yet. So I think perhaps people think that, well, if the market's beginning to go up, I can safely get back in. I can invest right now because that's telling me everything's fine with the economy. And actually, everything isn't fine with the U.S. economy.
So what would a healthy market move look like? I mean, today, a big kind of question that's been coming up is that we're about 3% away from all-time highs. What's it going to take for us to get there? But do you think it would be healthy for us to hit another all-time high in this environment?
Not necessarily. And I think actually that's part of the Fed's thinking also is, regardless of what any Fed rate cut would do to inflation, if the Fed were to cut rates aggressively, that might push valuations even higher in the equity market. Remember, we are at very high valuation levels on US equities. So I think from an investor perspective, the healthy thing to do is look at those valuations. There are plenty of things that aren't overvalued. Value stocks aren't overvalued. International stocks aren't overvalued. I think most fixed income is pretty much fairly valued. So there are ways of spreading money around in a diversified way. But I think it would be unhealthy if the market were just to soar straight to new highs, even as the economic foundations continue to, worsen somewhat here.
And since you mentioned international, something I've heard a lot from sources is the idea of looking at countries that are getting stimulus and investing in those countries. But they've also said that the international trade may be sustained on an idea of weaker countries becoming less weak via stimulus. And that doesn't sound that bullish to me. What do you make of that idea?
Well, that's true. And we may need a stronger idea to get American investors really excited about investing internationally. But I think you start with valuations. The fact that that even after a good few months, first few months of the year, U.S. PE ratios are about 50% higher for the ACWI ex-US. So international equities are cheaper. And then also, if you look at Europe, I think the fact that the Germans are now spending money, I think that Europe realizes that it is it hasn't spent enough money. It's got its fiscal policy is too tight, but also they face a real security threat from the East. Because of Russia. And I think they are waking up to that. I think they're quite aware of that. And so I think they will spend more in defense, and that could help the European economy rebound. In the US, we've got reckless consumers. They don't have them in Europe, and that's their problem. But I think European governments could spend more aggressively to try to build up their defense capabilities, and that could help a lot of European companies.
And I know domestically you mentioned value stocks. What is the defining factor of a strong value stock in this environment?
Well, I think I think have to have cash flows which aren't as vulnerable to a cyclical slowdown. So you don't want to think too much about very strong capital spending or luxury goods or very discretionary purchases. So I think that's part of it. And then you also want just more reasonable valuations. It should be more about cash that's being earned in the here and now rather than in the hereafter. But it's pretty easy to figure what's a non-value stock here. I think that's really the point. It's not so much there are a lot of opportunities out there. You just have to avoid buying stuff that you know in your heart is just silly. And if you can do that, you'll do fine.
I think that's a great overview, David. I do want to mention some headlines we're getting crossing the wire here. The Wall Street Journal citing people familiar with the matter on U.S. negotiations, saying Trump has said let the negotiators weigh lifting export controls. He also says he's going to let Besant levy tech sale controls in these China talks. And again, letting negotiators weigh lifting export controls more broadly. How big of a catalyst do you think that is if we do see a lifting of those export controls?
Well, I think it's helpful. I do think the high watermark for tariffs in the United States was really, in early April. And I think what I hope everybody's understanding here is that there is an integration in the global economy that you shouldn't just throw aside. This is not the 1930s or the 1830s. It is just too difficult to untangle the relationships among all of these countries at the drop of a hat. And so I hope that what this means is we're going to be all more reasonable on both sides or on all sides to try to maintain trade. We can have views as to how to make the economy, U.S. economy, more productive and more dynamic over time, and that could lead to a better trade position. But you don't want to do it overnight. You don't want to burn the existing trade boats before you build new ones. And I think that to the extent that negotiations are based on common sense and reason in both sides, that's all a good thing. And talking itself is a good thing.
Where do you think the tariff policy's impact in terms of inflation and the macro picture is going to net out? What do you think this is going to look like 6 months from now?
I think we will see higher inflation. Right now we're at a consumption deflation rate of 2.1% year over year, which is actually very close to the Fed's 2% target. But I think that by the end of the year, because of the tariffs, we'll be at about 3 to 3.5% of the consumption deflator. So we expect that we'll have this universal tariff of 10% will stay in place, probably 30% tariffs on China, something else, and different sectors. But overall, will add to inflation in the short run. And I think that inflation will be sustained to some extent by fiscal stimulus in the bill that's going through Congress. But by the end of next year, I think we'll be right back down to 2%. Tariffs are, inflation staggery rather than stagflationary. They initially give you inflation and then they just give you stagnation. They slow economic growth on both sides, and that slow economic growth will drag that inflation rate back down again. So I think it's a short-term issue with inflation, but the longer-term issue is just, does this actually make the American economy more dynamic or productive? And I'm afraid I don't think the tariffs do.
So it sounds like you don't see a risk of the Fed being too late to cut.
No, I think the real problem the Federal Reserve faces is interest rates aren't alarmingly high. I mean, a 4.25%, 4.5% on a short-term interest rates is on the federal funds rate isn't really too high. But the real issue is if you've got immigration policy which is limiting labor supply, and of course we need to do something to make to try to normalize the immigration situation. But if you discourage immigration altogether, if you discourage foreign investment, if you discourage international trade. If you do these things, then you will tend to both slow the economy down and push up inflation. And what the Fed is really saying is, look, we're going to wait until you can convince us that policies coming from the other side of Washington aren't going to push inflation up. And when we're convinced of that, then we can talk about beginning to lower interest rates. But right now, we need more clarity on fiscal policy, and we need to make sure that the policies in Washington, on the other side of Washington, don't actually add to inflation. I mean, and they don't want to be political. But I think they're just going to wait and see until they've got more clarity that we're not actually adding to inflation on one side of Washington while we're doing monetary ease on the other side.
And in our final minute, David, since you mentioned immigration, I want to get your take on the labor market. I've heard you say fascinating things before when we get layoff headlines that maybe, companies are trying to prevent people from asking for bonuses, for example. What would you say is your read on the news that we've been getting in over the past couple of weeks on increased layoffs at companies? Is that a signal of something more sinister under the hood, or is it regular for you?
No, I think it is a little bit more sinister. I mean, if you look at the Challenger Great Christmas, compiling of layoff announcements, they've been at very elevated levels for the last few months, and we're 47% up year over year in the month of May. So there's something real there. I do think it discourages workers for asking for big pay increases, and all things being, given the advent of tariffs, I don't think pay increases are excessive. But I think these layoff announcements are genuine. I mean, I think that companies don't want to do layoffs, but I think companies are frozen by the uncertainty caused by they don't know what the tariff story is, they don't know what the cyclical economic story is, they don't know what the tax story is, and the problem is, therefore, they all want to wait and see. And one of the things I think is so important to think about is that every day in America, American businesses make about 3 times as many hiring decisions as they make about firing decisions. A lot of people leave a job or quit, but you need to have a positive, optimistic, clear outlook from corporations so they actually feel comfortable making those hiring decisions. And I'm afraid that all this policy uncertainty is just making them hesitate to do that. Now, it also will tend to hold down wage inflation to some extent. So I'm not worried about wage inflation. In the long run, I'm worried about growth, not inflation in the U.S. economy.
David, a great overview. Thank you so much for making time for us this morning. Appreciate it.
Sure. Anytime.